Good morning. Today, we're diving into the latest numbers on inflation in the UK, a topic that's been on everyone's mind, from families planning their weekly shop to businesses setting their prices. Inflation affects us all, shaping the cost of everyday life and influencing the choices we make, big and small. Over the past year, we've all felt the pinch, whether it's at the supermarket checkout, filling up at the petrol station, or opening our energy bills at home. Prices have been climbing steadily, making it harder for many to stretch their paychecks to the end of the month. But today, there's a glimmer of good news. The latest figures show that UK consumer price inflation fell slightly in October 2025, dropping from 3.8% to 3.6%. While this might seem like a small change, it's a sign that the relentless upward march of prices could finally be slowing down. This is actually the first drop we've seen since May, breaking a months-long streak of stubbornly high inflation. For many, it offers a bit of hope that the worst of the price surges may be behind us, and that the cost of living might not keep rising at the same punishing pace. But what does inflation really mean? In simple terms, it's the rate at which the cost of living increases over time. When inflation is high, your money doesn't go as far as it used to, and everyday essentials can quickly become more expensive. For example, if a loaf of bread cost $1 last year, with inflation at 3.6%, that same loaf now costs about 1.04. It might not sound like much, but those extra pennies add up across your weekly shop, your fuel, and your bills. So, while prices are still rising, they're not climbing as quickly as before. That means the pressure on your wallet is easing a little, but it's not gone. The cost of living is still higher than it was a year ago, and many households are still feeling the strain. This slowdown in inflation is a welcome relief after months of anxiety and uncertainty. It's also in line with what the Bank of England and many economists had predicted, suggesting that some of the measures taken to control inflation are starting to work. The latest data suggests that some of the pressures driving prices up, like supply chain issues and high energy costs, are beginning to ease. Factories and businesses are seeing more stability, and that's helping to slow the pace of price increases. For families who have been watching every penny, even a small sign of improvement can make a real difference. It might mean a little less worry at the end of the month, or the ability to put a bit more aside for the future. But it's important to keep things in perspective. At 3.6%, inflation is still well above the Bank of England's 2% target. That means we're not out of the woods yet, and there's still work to do to bring prices back under control. The squeeze on household finances isn't over, and the journey back to stable, predictable prices will be gradual. Many families are still making tough choices about where to cut back, and some are dipping into savings just to get by. So, while this is a step in the right direction, it's not a reason to celebrate just yet. The road to lower inflation is a long one, but today's news offers a bit of hope that things are finally starting to move in the right direction. A closer look at the October figures. The latest inflation numbers have caught the attention of economists, policymakers, and everyday shoppers alike. After months of stubbornly high prices, the recent dip in inflation has sparked questions about what's really driving the change, and whether it signals a turning point for the UK economy. What caused this small dip in inflation? For many, the cost of living crisis has felt relentless, so even a modest slowdown in price rises is significant. But to understand why inflation eased, we need to look at the details behind the numbers. It comes down to the shopping basket of goods and services used to calculate the Consumer Prices Index. This basket reflects what typical households buy, from groceries and fuel to clothing and transport. Fuel prices rose less sharply this autumn, providing some relief at the pumps. While petrol and diesel are still expensive, the pace of increases has slowed compared to last year, easing pressure on household budgets. At the same time, food price increases have started to slow. Shoppers may still notice high prices, but the rate at which they're rising has cooled, especially for staples like bread, milk, and vegetables. Global food prices have stabilized, thanks in part to improved supply chains and better harvests in key exporting countries. This has helped keep imported food costs in check for UK retailers and consumers. Supermarket competition is also playing a role, as major chains battle to attract customers by keeping price hikes to a minimum. Prices for household goods, from cleaning products to toiletries, have seen less dramatic increases as a result. Prices for second-hand cars, which soared during the pandemic, have also stabilized. The market is less frantic now, with more vehicles available and demand cooling, so prices haven't climbed as steeply. It's important to remember that inflation is measured year on year. That means big jumps from last year are now dropping out of the calculation. These so-called base effects are helping to lower the current rate, even if prices remain high. There's no single reason for the dip. It's a mix of smaller, less severe price rises across the economy. From groceries to fuel and from household goods to used cars, the pressure has eased in several areas at once. This suggests inflationary pressures are easing, but the situation remains complex. Some costs are still rising, and global events or supply chain issues could quickly change the outlook. A slowdown in one area could be offset by a spike in another, so the Bank of England is watching closely. Policymakers are cautious, knowing that inflation can be unpredictable and that new shocks could emerge. The fight against inflation is far from over. While the recent dip is encouraging, it's only one step on a long road to stable prices and economic certainty for households across the UK. What does a drop from 3.8% to 3.6% inflation mean for your budget? It won't make your shopping cheaper overnight, but it signals that price rises are slowing. If your weekly shop was $100 last month, it's still going up, just a bit less than before. Over a year, these small differences add up across all your spending. For those on fixed incomes, a slower rise in prices means your money stretches a little further. The psychological impact matters too. Seeing inflation fall, even slightly, brings some relief. But let's be realistic. Prices are still much higher than a couple of years ago. The climb is less steep, but we're not coming down the mountain yet. Budgeting remains crucial, and the financial pain isn't over. Here's the big question. If inflation is falling, why do prices keep rising? A lower inflation rate means prices are rising more slowly, not that they're dropping. Think of it like turning down the tap in a bathtub. Water, prices, is still rising, just not as fast. For prices to actually fall, we'd need deflation, a negative inflation rate. So, even with inflation at 3.6%, things cost 3.6% more than a year ago. The good news, the pace of increases is slowing. But months of high inflation have left prices much higher than before. 1 month of slower inflation can't undo that. It'll take a long stretch of low inflation before finances feel stable again. Until then, prices will keep climbing, just hopefully not as fast. The Bank of England is watching these numbers closely. While the drop in inflation is welcome, the bank remains cautious and has paused interest rate cuts. Their main tool, raising interest rates, makes borrowing more expensive to cool the economy and bring inflation down. They worry inflation could stay sticky and not fall to the 2% target until 2027. Fast wage growth without productivity gains could keep inflation high, so the bank is holding rates steady. For borrowers, this means higher costs will stick around for a while. Could pay rises be part of the inflation problem? Wages have been rising quickly, helping people cope with higher prices. But for economists, rapid wage growth can fuel inflation if businesses pass those costs to customers. This creates a wage price spiral. Higher wages lead to higher prices, which lead to demands for even higher wages. The Bank of England says wage growth is outpacing what's sustainable for 2% inflation, especially with weak productivity. If productivity doesn't rise, wage increases often mean higher prices. Policymakers face a tough balance. People need pay rises, but too much wage growth risks keeping inflation high. There's no easy answer, which is why the bank remains cautious. The wage inflation puzzle is far from solved. The government also plays a role in fighting inflation through tax and spending decisions. Right now, it's a balancing act. Help struggling households, but avoid stoking inflation with too much stimulus. The upcoming budget is expected to be cautious, with little room for big tax cuts or spending sprees. Past policies, like raising the minimum wage, may have unintentionally pushed inflation higher by increasing business costs. Every government move is now scrutinized for its impact on prices. Support for households will need to be targeted to avoid boosting demand too much. The government must balance relief with fiscal discipline to get inflation under control. All eyes are on the next budget statement. How does UK inflation stack up globally? High inflation has been a worldwide problem, but the UK's rate remains the highest among major economies. The US and Eurozone have brought inflation closer to their 2% targets, allowing their central banks to consider rate cuts. The UK lags behind, with unique challenges: strong wage growth, weak productivity, and a slower pass-through of falling energy prices. Brexit's impact on business costs and labor shortages may also be a factor. Higher inflation means higher interest rates for longer, making the UK less attractive for investment. The squeeze on UK households is more severe and prolonged than in the US or Germany. Closing the gap with other countries is now a top priority. As we look ahead to 2026, many people across the UK are wondering what the next year will bring for their personal finances. After a period of economic uncertainty and rising costs, it's natural to feel cautious about what's coming next. So, what should you expect for your money in the coming year? The recent drop in inflation to 3.6% is certainly a positive development, offering some relief after months of higher prices. However, the journey back to the Bank of England's 2% target is expected to be slow and steady, rather than immediate. This means that while prices will continue to rise, the pace of those increases should be less dramatic than what we've seen recently. Everyday essentials like groceries may still cost more, but the hope is that the sharp spikes are behind us. For many households, budgets will remain tight, especially when it comes to necessities such as energy and food. These are areas where families have felt the most pressure. And unfortunately, relief will be gradual rather than immediate. The worst of the price shocks may be behind us, but don't expect a sudden return to the days of cheap goods and services. Instead, improvement will come in small steps, and it will take time for households to truly feel the difference. Interest rates are another area to watch. While many hope for lower borrowing costs, the reality is that rates are likely to remain elevated for a while longer. This means loans, credit cards, and mortgages will continue to be expensive. For mortgage holders, especially those on variable rates or looking to remortgage, significant relief is still some way off. Planning ahead and seeking advice could help manage these ongoing costs. Still, there is reason for cautious optimism. The economic crisis is easing, and while the recovery will be slow, there are signs of stability returning. Many families are learning to adapt and make the most of their resources. Patience will be essential in the months ahead. Turning inflation around and restoring financial confidence takes time, and it's important to stay focused on long-term goals. While true stability is on the horizon, a return to the low-price days of the past isn't likely to happen overnight. For now, careful planning and a positive outlook will help you navigate the year ahead.